Welcome to Market Movers. I'm Jim Uriel with Scott Martin.
Hi, Jim.
Hi. We heard from the Fed today in the form of the FOMC. Did they sound concerned to you? I'm kind of speaking about coronavirus, but not exclusively.
No, I believe they were somewhat concerned about things they should be concerned about. You know, there's a different way to look at concern when it seems like they're overly doing it, especially the dovish side as they've been lately, Jim. But with respect to what they're paying attention to, which is slow growth, coronavirus, I think it was right down the middle as far as, let's say, concern.
Okay, they said moderate instead of strong when they were talking about the households. Do you think they sound more dovish today than they have 3 weeks ago, 4 weeks ago, last we heard of them?
Yeah, for sure. And I think there's a couple reasons there. One is the data is backing that up. Two is the fact that the interest rate cuts, 3 of them that we got last year, are starting to work their way through the system. And so I think the Fed is right on target, right on point with how they should feel about things going on outside their door.
Before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. When we priced these out, the March 10-year contract was trading right around 131 the buck.
Yeah, and moving around a little bit today, Jim, obviously on FOMC day. And it's funny, just given all the kind of, let's say, just bearishness that is out there in bonds and certainly the dovishness that I just mentioned with the Fed, I think it's time to actually go maybe the other way, Jim, with an expression here, which I'm going to tell you right now as an example of buying the week 2 130 quarter, 129 3/4 put spread for just under 8 ticks. This trade risks 125 to make a potential 375. But Jim, I'm pretty cheap. So I'm going to pay for this by selling a call at 132 half for, yes, you guessed it, just under 8 ticks. So my risk becomes, so I get the put spread paid for, but my risk becomes is that the market continues to rally bonds and I get short at 132 half. This trade expires, by the way, on your favorite day of the year, Valentine's Day, February 14th. And again, just has a little bit of a bearish build into it with that selling of the call on the upside, just in case you didn't want to pay for the put spread here, the protection.
I like structuring it that way. Generally speaking, I don't like to sell a call in either gold or 10-year instruments that sometimes rally hard in moments of market panic. I'd probably change it into a call spread. But other than that, I think it's a pretty good expression of the way to do it. I'm not that direction. I actually think rates are probably going lower and prices are going higher. I think they did sound dovish, so I actually did put on a call fly, and I did one of those unbalanced call flies. So it's the week 1 Feb, it expires February 7th, a week before Scott's, and it's buying the 131.5 132 call spread, so buying a 50 wide call spread, and then selling the 132 132.25 call spread. So you buy the 50 wide call spread and sell the 25 wide call spread. I did that for 5 ticks. You buy it for 5 ticks, you risk 78 bucks to make a potential 422 if it goes to the middle. One of the things I like about that is if it screams higher, you still make a little bit of money. You don't, in a regular fly, you lose it all.
Exactly.
You lose all thoughts.
Not too bad, because Jim, if you look at some of those levels on your call spread too, in the call fly, it has some levels in there that I was pointing out too that might be some support resistance. I think these are both expressions where there is going to be some volatility, certainly in ZN, as we have fallout from the Fed today. So that would be levels too that I would be managing around if the trade goes against or in favor of your
Last quick
positioning.
question. Jay Powell said he thought asset prices were a little bit elevated, but not extremely so. Do you think that matters to the stock market?
Not so much, other than the fact that it's true, number one, and the fact that the Fed is right on target with respect to what they've done so far, what asset prices have done in response, and probably where they're going, which is not much higher.
Thanks for joining us on Market Movers. I'm Jim Uriel, where we are helping to make you a better trader.